Good evening, everyone. My name is Jamil Abdul-Rahim, go by Coach Jamil from Asymmetry Trading. Today, we'll be talking about timing the market with market timing. A little bit about myself and the introduction to asymmetry trading. Again, my name is Jamil. I started my banking and trading career at JP Morgan. Once I graduated from EYL University in North Carolina, I started with an IB, fixed income, and had various roles throughout my career at JP, working with marketing and middle office and the traders, and then finally leaving to start my own, journey and path in trading for myself. Tonight, we're going to be talking about supply and demand. Through my journey, I've had, different mentorship that has that's guided me, formulate my own style of trading, my own risk management and trade management to, encompass like asymmetry trading. We'll then begin into some multiple time frame analysis, and then, get into some live charts, some live examples of the market. And right now the futures market is open. It opened at 6 p.m. Eastern Standard Time. All right. About asymmetry trading. At asymmetry trading, we understand the importance of reading the market. Our trading decisions are centered around supply and demand, identifying where the buyers and where the true sellers are in the market, and using price patterns that I call them pins to the market. The reason I call them pins to the market is because these are the patterns that we use to extract money out of the market. Everyone pretty much has a debit card, and everyone has a pin to that debit card. So these patterns is what I basically call pins to the market. We risk less to make more using multiple time frame analysis, using top-down analysis. Supply and demand logic, think of the market like an auction. Bids and offers, or bid and ask is synonymous with offer, come into the marketplace, and those orders must get filled. Everyone probably on this call, and everyone does something, and that's place an order. Whether it's place an order with Amazon, place an order at a restaurant, we place an order. And we'll get into that in the live markets. But what has to happen when we place that order? That order has to get filled. And we are going to go through what that looks like on a chart. So demand is where the unfilled buy orders are not filled. That's what we're looking at when we look at demand. Supply is where the unfilled sell orders are not filled. And again, back to those pins of the market, we have price patterns that show those supply and demand zones. Our goal is to identify supply and demand zones on a chart and see where these low risk, high reward opportunities are. So supply exists when there's more willing sellers at a price point than willing buyers. And two of the patterns that we use to identify supply is a rally-based drop, a drop-based drop. And we'll go over what that looks like on a chart. Try to keep it simple. I want to simplify this for everyone. Here, this is an example of a drop-based drop. Price drops right here. This is the ES. So what we're looking at is a chart of the ES. This is the S&P, the futures S&P 500. Looks very similar to the SPY and the SPX. One of the pins to the market is price drops, it bases and drops. A base, what does a base consist of? A base consists of a candle closing inside the range of a previous candle. So this right here is where the battle exists, where there are more sell orders than buy orders once price drops, and leaving behind unfilled sell orders. So price drops, it bases, there's a battle between buyers and sellers right here, where price is going up. Price is going down. On this green candle, price is going up. And on this red candle, price is going down. At that point, there are more sellers than buyers, leaving behind unfilled sell orders. When price comes back, this is the test of this supply zone. The next zone, this is a rally-based drop. This is the next pin, a rally-based drop. Price rallies up. Again, what's a base consist of? A base price closing inside the range of its previous candle, another candle closing inside the range of a previous candle and dropping. leaving behind unfilled sell orders that need to get filled, creating, once price drops, creating a supply zone where there's more willing sellers than buyers at this zone. When price comes back, retest this zone, again, there's more sell orders, unfilled sell orders than buy orders, and price drops away. This is how we reduce our risk and maximize our profit. All right, demand is just the inverse of supply. Demand exists where there are more willing buyers than willing sellers at a particular price level. The patterns that we use for demand are rally-based rallies and drop-based rallies. And this is what they look like. Okay, so here, prices drop. Again, price drops, bases. You have candles that consolidate within the range of its previous candles. We're seeing right here the battle playing out between buyers and sellers. The sellers lose that battle. Price rallies up, leaving behind unfilled buy orders and creating a demand zone. When price comes back, there's more willing buyers than sellers at this price level, and price rallies up. This is the retest of this demand level. And as we can see, all right, in auction theory, so this is it's the same zone, a drop-based rally, but you can see how there's a lot more buyers, a lot more willing buyers at this level than sellers. Price comes here. I want to make sure you guys see this, understand this. This is the first test of this zone right here. There's extreme buying at this level. There are no sellers. There are more willing buyers at this level. This is the first test right here, the first retest, and price rallies up, comes to the zone and rallies up. The next test to the zone, again, there's a lot more willing buyers than sellers in the market. And just below that pivot low, this is where, there's more willing buyers than sellers. And this is why price rallies. Sellers are completely exhausted. There are no sellers at this price level. There are more willing buyers than sellers at this price level. Price comes back, trades sideways, and then rallies away. The next pin, a rally, base rally. Price rallies up. Bases, you have candles that close inside the previous candle and then rallies up. Potentially tries to pull back. That's how you know another reason why there's extreme buying here at this level, because price tries to pull back to this level where there's no willing sellers here and continues to rally away, creating a demand zone where there are no sellers at this level and more willing buyers. Price comes back and retests this level and rallies away. Multiple time frame analysis, how we go about it. This is how we mitigate our risk, reduce our risk to maximize our profits. Multiple time frame analysis, we go from a macro perspective, top-down analysis starting on a daily time frame, going down to a lower time frame, going to a micro perspective. You do this by identifying the 4 pins in the market. The 4 pins in the market do not change. The market is fractal. So whether it's a daily time frame, a 60-minute time frame, a 30-minute time frame, a 10-minute time frame, the patterns are the same. The patterns are fractal. We use these 4 pins to we identify. We do this by identifying the 4 pins to the market for supply and demand, starting with the daily and drilling down to a lower time frame. This will help you time the market on when you get into the trade and reduce your risk.